Thanks everyone for being here, and I want to thank the University of Sydney and Dean Whitwell and Professors Kim and Wu for inviting me to participate in today's conference. I think it's a very timely topic, and I do really appreciate the invitation. Since 2008, the global financial crisis, economists and policymakers all over the world have been evaluating the factors that led to the crisis, assessing what could have been done to prevent it or at least limit the damage, and considering what can and should be done to reduce the probability and impact of future disruptions to financial stability. And to its credit, and understanding the importance of the financial system to a vital economy, Australia began undertaking thoughtful and periodic reviews of the financial system and regulatory structure well before the crisis. And based on the recommendations coming out of these inquiries, Australian policymakers implemented changes to address the evolving landscape of the financial services industry. So I appreciate the opportunity to be here today to learn more about the financial stability efforts underway here and to provide a perspective from the other side of the Pacific. And today I want to focus my remarks on the connections between monetary policy and financial stability. To help put that discussion into context, I'm going to start with a brief overview of the U.S. financial system regulatory structure as it pertains to financial stability. And I should note that the views I'll present today are my own and not necessarily those of the Federal Reserve System or my colleagues on the Federal Open Market Committee. So it's probably an understatement to say that the financial system regulatory structure in the U.S. is complex. In part, its complexity results from the wide array of institutions that provide financial services, helping to support an $18 trillion economy. Banks is a category that includes commercial banks, savings and loans, and credit unions, and they provide only about a third of the credit in the U.S. Other providers include insurance companies, mutual funds, pension funds, government-sponsored enterprises, including Fannie Mae and Freddie Mac, which issue mortgage-backed securities, and other non-banks, including broker-dealers, financial companies, and mortgage real estate investment trusts. These diverse financial institutions are able to provide valuable credit risk management and liquidity services to businesses and households because they are designed to take risk and are highly leveraged compared to non-financial businesses. But this risk-taking and leverage raise the possibility of systemic problems that could threaten the functioning of the financial system, hurt real economic activity, and impose significant economic costs. Now, the 2008 financial crisis exposed gaps in the regulatory and supervisory architecture in the U.S., which contributed to a buildup in financial imbalances and systemic risk. In response to the crisis, the Dodd-Frank Wall Street Reform and Consumer Protection Act was signed into law in 2010. Provisions in the Act aim to foster financial stability in two ways. First, by lowering the probability of a financial crisis, and second, by reducing the cost imposed on the rest of the economy when a shock hits the financial system. Now, under Dodd-Frank, the Federal Reserve and other financial regulatory agencies in the U.S. were directed to augment their traditional microprudential approach, which promotes the safety and soundness of individual institutions, with a macroprudential approach in which examiners and supervisors take a horizontal view of risk across institutions rather than looking only at one institution at a time. And although there's still more work to be done, U.S. regulators continue to make progress in developing tools to implement the macroprudential approach and to monitor the risk over the business and financial cycles. In the U.S., the application of these tools is complicated by the complexity of the regulatory structure itself. At the federal level, there are multiple financial regulators, including the Federal Reserve, the Federal Deposits Insurance Corporation, the Office of the Comptroller of the Currency, the National Credit Union Association, the U.S. Treasury, the Securities and Exchange Commission, the Commodity Futures Trading Commission, the Consumer Financial Protection Bureau, and the Federal Housing Finance Agency. There are financial system regulators at the state level as well. In many cases, the regulatory authority of these agencies is defined by the type of institution rather than by financial instrument. The Dodd-Frank Act created the Financial Stability Oversight Council, or FSOC, to promote coordination and information sharing across these financial system regulators. The 10 voting members of the FSOC include the heads of the 9 federal regulatory agencies that I just mentioned, and an independent member with insurance expertise who is appointed by the President of the United States. An important power of the FSOC is its ability to designate non-banks as systemically important, bringing them under more bank-type supervision and regulation. The Board of Governors of the Federal Reserve System has the responsibility for supervising systemically important financial institutions, including these FSOC-designated non-bank financial companies, large bank holding companies, and the U.S. operations of certain foreign banking organizations. Now, the complexity of the financial system makes monitoring risk more complicated as well. The Office of Financial Research, established under Dodd-Frank, is collecting data to aid in this task. And the Federal Reserve has also developed a framework for systematically tracking risks, which is helping us to better identify changes in conditions over time. Financial stability surveillance is receiving regular attention at meetings of the Federal Open Market Committee, the FOMC, which is the body within the Federal Reserve that's responsible for setting monetary policy. So one might ask why that's the case, given that financial stability is not an explicit part of the FOMC's monetary policy mandate. And it's because the goals of monetary policy and financial stability are interconnected. So in my view, central banks should care about financial stability to the extent that it affects the health of the real economy. Volatility or minor disruptions in financial markets that represent the ebb and flow of a dynamic economy but don't threaten the health of the economy are not something that monetary policy should respond to. Indeed, to the extent that the word stability gives the impression that the financial system is static, we may actually want to adopt the language used in the United Kingdom and speak about financial system resiliency. That is, the financial system's ability to continue to provide the core financial services of intermediation, risk management, and payments in the face of the inevitable shocks that will hit a dynamic economy. Monetary policy mainly works through its ability to affect current and expected future interest rates. However, in certain circumstances, it also has the ability to affect risk-taking by investors and financial institutions, and thereby is linked to financial stability. I believe that in general, the goals of monetary policy and financial stability are complementary. For example, price stability helps businesses, households, and financial institutions make better decisions, thereby fostering the stability of the financial system. And a stable financial system allows for more effective transmission of monetary policy throughout the economy. I view this complementarity as similar to the complementarity between the two monetary policy goals that the U.S. Congress has given to the FOMC, namely price stability and maximum employment. But during the financial crisis, we learned that financial imbalances can build up even in a low inflation environment. So that while price stability may promote financial stability, it's not a sufficient condition. And we also learned that financial instability can arise from non-banks and from institutions that are solvent and not necessarily highly leveraged. A large body of research has aided our understanding about how systemic risk can build up and propagate through the economy. Well before the financial crisis, Kiyotaki and Moore did seminal work on the important role collateral plays in lending markets. Now, in their model, because borrowers cannot be forced to repay, all lending is collateralized. When the economy is performing well, the value of the collateral increases, which supports further borrowing and higher output. But when a negative shock hits the economy and output declines, collateral values also fall, which means borrowing falls, which depresses output even further. Thus, the collateral constraint is a mechanism that amplifies and propagates the effects of temporary shocks on the economy. Bruner, Meyer, and Sanikoff build on the Kiyotaki and Moore model. In their model, an economic boom increases bank capital levels high enough so that credit is amply available to borrowers. This lowers the volatility of both output and asset prices. The lower volatility induces banks to increase their leverage and lend even more. so much so that the system is now vulnerable to a negative shock. Gordon and Ordonez examine how private market activities generate endogenous accumulations and subsequent collapses in leverage. These models all illustrate that systemic risk is endogenous, determined by the choices of the model's decision makers, and that it varies over the business cycle. During the financial crisis, we saw that when financial markets are not functioning well, the transmission of monetary policy to the economy can be disrupted. In those circumstances, the actions taken to implement monetary policy can also affect financial stability. The FOMC has acknowledged that non-conventional monetary policy, including large-scale asset purchases and the extended period of very low interest rates, could pose potential risks to financial stability by affecting market functioning and by spurring risk-taking in a search for yield. Empirical work is beginning to document this effect. For example, Jimenez, Ongena, Pedro, and Zorina used data on 23 million bank loans from the Spanish credit registry and find that a lower overnight policy rate induces low-capitalized banks to lend more to ex-ante riskier firms and to require less collateral compared to high-capitalized banks. This is direct evidence of monetary policy's effect on risk-taking. Thus, while I believe that in most circumstances the goals of monetary policy and financial stability are complementary, we need to recognize that at times actions taken to foster financial stability and those taken to promote our monetary policy goals might be in conflict, at least in the short run. In the United Kingdom, the Financial Services Act recognizes this potential trade-off and explicitly says that the Financial Policy Committee is not authorized to act in a way that it feels is, quote, likely to have a significant adverse effect on the capacity of the financial sector to contribute to the growth of the UK economy in the medium or long run, end quote. Now, in deciding whether to take action against a growing imbalance, policymakers need to balance the expected improvement in future economic conditions against the potential cost of unduly limiting credit extension. Too high a resiliency standard will thwart risk-taking and innovation, which will undermine longer-run economic growth. In setting the standard, we need to come to some common understanding about the amount of growth and prosperity we are willing to give up in order to lower the risk to financial stability. In the US, people who are 80 years old have lived through two major financial crises, the Great Depression and the 2008 crisis. Is that too many? Would we rather lower the probability of such an event to 1 every 1,000 years? And what would we be willing to give up to do that? Now, of course, that may be a premature question at this point. There are likely things that can be done and that are being done to lower the risk to financial stability without much cost in terms of economic growth. If we think of there being a risk-return frontier relating financial stability risks to the economic return that a well-functioning financial system can provide, then it isn't hard to imagine that we were operating at a point well interior to that frontier in the run-up to the crisis, and that the improvements being made in our financial regulatory and supervisory regime are moving us toward the frontier without sacrificing growth. To foster the resiliency of the financial system, regulators in the US and throughout the world are developing macroprudential tools aimed at lowering the probability that instability will arise and to limit the damage when financial shocks do arise. Some tools focus on building up the structural resiliency of the financial system throughout the business cycle. And in my view, these structural resiliency tools are the most promising. They include the Basel III risk-based capital requirements, minimum liquidity requirements, central clearing for derivatives, and bank stress tests. Living will resolution plans and orderly liquidation authority, which is housed at the FDIC in the US, are intended to make it easier for regulators and policymakers to allow large, complex financial institutions to fail. In addition to the structural tools, there are counter-cyclical tools that aim to mitigate the systemic risk that can build up over the business cycle. These include the counter-cyclical capital buffer and the capital conservation buffer. Other possible cyclical tools not yet established in the U.S. but used in other countries include loan-to-value ratio limits and debt-to-income ratio limits that vary over the cycle and which have been targeted to particular sectors like housing credit or household credit. The performance of the set of macroprudential tools is largely untested. Cross-country studies find mixed results, with the effectiveness of the tools varying with the economic circumstances and the types of shocks hitting the financial sector. In the U.S., the need to coordinate counter-cyclical macroprudential policy actions across multiple regulators adds a complication to effectively using such tools in a timely way. Currently, policymakers in the UK are putting one of the counter-cyclical tools to the test. The uncertainty arising from the UK's voters' decision to exit the European Union has the potential to dampen economic performance in the UK. In response, policymakers there have taken steps to ease credit conditions. One such step taken by the Bank of England's Financial Policy Committee is a reduction in the counter-cyclical capital buffer rate for banks to 0% from 0.5% of banks' UK exposures, with the expectation that the 0% rate will be maintained until at least June 2017. So this is a reduction in regulatory capital buffers by £5.7 billion, which the FPC estimates will raise banks' capacity to lend by as much as £150 billion, or the equivalent of about 260 billion Australian dollars, or about 190 billion US dollars. Usually when one thinks about the use of the counter-cyclical tools, it is to mitigate building financial stability risk by tightening credit conditions. But here's an example of the use of a macroprudential tool to ease credit conditions in support of monetary policy goals. So this is an illustration of the nexus between monetary policy and financial stability policy. Another connection between the two stems from hard-won lessons learned from years of monetary policy setting, lessons that can now be productively applied to financial stability policy setting. So I'm going to discuss two lessons. First, to the extent possible, policymakers should take a systematic approach in applying financial stability policy rather than relying on discretion. The financial crisis underscored the important role of incentives in financial markets, not only the incentives of financial institutions, but also those of regulators and policymakers. Time and consistency problems and moral hazard issues are important factors that need to be considered when designing a framework for implementing financial stability policy. These types of problems argue for taking a systematic approach to such policymaking. The benefits of systematic monetary policy are well established. When monetary policymakers respond in a systematic fashion to incoming information, the public will have a better sense of how policymakers are likely to react to economic developments, whether those developments are anticipated or unanticipated. So their policy expectations will better align with those of policymakers. This alignment helps the public make better financial and economic decisions, thereby making monetary policy more effective. An additional benefit of a systematic approach is that it provides a mechanism through which policymakers can commit to policies aimed at promoting policy goals over the longer run. Being systematic can help alleviate time and consistency problems in monetary policy, whereby policymakers may favor the short run over the long run. Now, note that by systematic policy, I don't mean that monetary policy will be set mechanically by a policy rule, or that policymakers need to be prescient about the types of shocks that will hit the economy. Rather, I mean that policy will react in a systematic fashion to economic developments that change the economic outlook. A systematic approach to financial stability policy is perhaps even more important than in the case of monetary policy, because of the important role played by incentives. The crisis shined a bright light on significant moral hazard problems that exist in financial markets. A financial stability policymaker that is systematic in how it applies its tools to promote stability will likely help tame some of the moral hazard problems, and also some of the time and consistency problems to which the regulators themselves are subject. An important tool in this regard is the resolution of insolvent financial institutions. Without a credible resolution method during the crisis, in the face of serious distress at a large financial firm, governments face a dilemma. Either rescue the firm and create future moral hazard problems, or let the firm fail and risk causing a cascade of other failures. The fact that policymakers had to make these decisions in the heat of the moment, using their best judgment based on limited information, didn't help. Without a credible resolution method, it is reasonable to expect that even well-intentioned policymakers will be biased towards bailouts. A resolution method that can be applied systematically can help alleviate this problem. The living will resolution plans and orderly liquidation authority in the U.S. are promising, but still untested tools in a process that will allow large firms to fail. This in turn provides incentives for these large, systematically important institutions to reorganize themselves in a way that reduces the risk they pose to the financial system. Now, as I mentioned, the Federal Reserve is becoming more systematic in monitoring risks across the financial system. Coupling that monitoring with the application of a resiliency standard across the entire financial services landscape, including the so-called shadow banking system that was less heavily regulated in the past, would limit regulatory arbitrage. As the financial crisis made clear, taking an action that pushes risk from one set of institutions to another doesn't eliminate the risk. It just moves it around, potentially to a part of the financial system where the risk is more difficult to monitor and to control. Now, I acknowledge that this broad application of the resiliency standard across the financial system may be particularly difficult in the U.S. with its complex regulatory structure. Still, I think we can devise ways to make the macroprudential tools more systematic and less discretionary. Regulators could agree in advance on the contingencies under which the cyclical macroprudential tools would be invoked, rather than waiting until the risk escalated before starting the process to coordinate action. For example, we can write down a formula for a counter-cyclical buffer, and we can define an explicit trigger for contingent convertible bonds. Knowing that such policies will be systematically applied and what will trigger them may induce financial market participants to limit the buildup of risk in the first place. A second lesson we've learned from setting monetary policy, or perhaps we're still learning it, is the importance of transparency and clear communication. In my view, to be effective, macroprudential policy actions must be communicated in a clear way to avoid creating a conflict with or causing confusion over actions taken to foster monetary policy goals. Transparency and clear communication are hallmarks of best practice monetary policy making. Clear communication helps align the public's expectations, policy expectations, which makes monetary policy more effective. Transparency is necessary so that the public and elected officials have the ability to hold monetary policymakers accountable for their decisions. The Federal Reserve has been given independence in setting monetary policy, which has been well documented as yielding more effective policy and better economic outcomes. But accountability must go hand in hand with independence, so the Federal Reserve regularly communicates the basis for its policy decisions. A parallel can be drawn with financial stability policy. Although in some cases prudential supervisory information should be kept private, as a general principle, I think that financial stability policymakers should strive for greater transparency and more disclosure. Similarly, they should require more disclosure from financial firms so that creditors and other market participants can exert market discipline. Of course, clear communication is easier said than done. Three aspects make this even harder for financial stability policy than for monetary policy. First, the framework and tools of financial stability policy are new. It will take considerable effort on the part of the financial stability policymakers to explain the tools they're using and the rationale for their policy decisions. However, such communication is necessary so that the public understands when an action is being taken because of concerns about financial stability rather than concerns about monetary policy goals. This would be particularly true when the Monetary Policy Authority is also responsible for taking financial stability actions, and if the monetary policy were the tool used to address the financial stability concerns. It's worth considering whether separating decisions about financial stability from decisions about monetary policy within a central bank, perhaps by having separate committees, as in the UK, would aid communication and decision-making. A second complication in effective communication of financial stability policy is timing. If effective monetary policy means taking away the punch bowl just as the party gets going, then effective financial stability policy might mean taking away the punch bowl even before the guests have arrived, because the seeds of financial instability are sown much earlier, and action must be taken earlier as well. If the need for monetary policy to be forward-looking is a difficult concept for the public to grasp, the need for financial stability policy to act well before there are clear signs of instability may be even more difficult to explain. Yet a third complication in effective communication is the complexity of the financial regulatory regime itself. In my view, a sometimes overlooked lesson from the crisis is that regulatory complexity can complicate supervision, risk monitoring, compliance, and enforcement. Given the scope and ever-changing nature of the financial system, regulatory complexity is to a certain extent unavoidable, but the trade-off should be recognized. For example, it is reasonable to require banks to hold higher levels of capital against higher risk assets, but a system of risk weights that's overly granular and complex would be counterproductive. In practice, too much complexity would make it harder for regulators to assess compliance and to determine whether institutions were engaging in some practices merely as a way to hide risk and lower their capital requirements. If regulators have made the rules so complex that they cannot assess compliance, then in practice there are no consequences for firms that fail to meet the standards. Complexity also makes it difficult to monitor the monitors. So it might be worth exploring whether we would be better off with a much simpler macro and microprudential supervisory structure, one that's easier to implement and simpler to govern, and that is approximately right across various economic models and states of the world, even if it is never optimal in any particular model or state of the world. Of course, we're not in that simpler regime. So the question is, given the current financial structure in the US, how should policy respond to emerging financial stability risks, and what role should monetary policy play? So I don't believe that financial stability should be added to the Federal Reserve's statutory monetary policy goals of price stability and maximum employment. But I do think US monetary policy makers need to remain cognizant of the linkages between financial stability and our monetary policy goals. In my view, the first line of defense against financial instability involves the tools that will make the structure of the financial system less prone to crisis. These structural resiliency tools include higher capital standards, including a minimum non-risk-based leverage ratio, as well as risk-based capital standards, liquidity standards, stress tests, living wills, and effective resolution methods for systemically important bank and non-bank financial institutions. Much work has been done to develop these structural resiliency tools, and I believe the system is in a better position to handle shocks now than it was before the financial crisis. Counter-cyclical macroprudential tools such as limits on loan-to-value ratios in particular markets are worth further study, but at this point I'm not convinced that we have enough knowledge and experience with them to use them effectively in the United States. That consideration leads me to think that we should set standards for the structural resiliency tools somewhat higher than they would be if we had more confidence in these counter-cyclical tools. Now, what about using monetary policy to combat heightened financial stability risk? As I've discussed, monetary policy and financial stability goals and actions are interrelated. Very loose monetary policy increases the likelihood that financial instabilities will develop, thereby increasing the likelihood that the macroprudential policy tools will be needed. And tight macroprudential policy can tighten financial conditions more generally, thereby increasing the likelihood that a monetary policy response will be needed. That said, in my view, US monetary policy should remain focused on promoting price stability and maximum employment, and financial stability should not be addressed or added as a third objective for monetary policy. course, it isn't clear that monetary policy would be very effective against emerging financial stability risk. While interest rates affect the fundamental value of assets, it's not clear that they affect the speculative or bubble portion. The impact may depend on the underlying nature of the financial imbalance. And second, monetary policy tends to be a blunt instrument, so any benefits of using it to stem financial imbalances, mispricing of assets, or excessive leverage need to be weighed against the economic cost in terms of price stability and employment. Lars Svensson brings some metrics to this question and concludes that the costs outweigh the benefits. Now, while I don't believe financial stability should be part of the Fed's monetary policy mandate, monetary policies need to be aware of the linkages between our monetary policy actions and financial stability. In the case of the housing market, which precipitated the last crisis, policymakers underestimated the breadth and depth of the negative impact this would have on the rest of the economy and financial system. To the extent that we misjudge the impact, there's a larger potential gain to carefully monitoring financial market conditions, implementing the structural macroprudential tools, and being open to taking offsetting action should imbalances develop. If our macroprudential tools prove to be inadequate and financial stability risks continue to grow, I believe monetary policy should be on the table as a possible defense. However, in this case, the blurring between financial stability and monetary policy goals would be high. If we assess the risks of financial stability to be sufficiently great, achieving our dual mandate monetary policy goals would also be in jeopardy. Which brings me back to my original point. In most cases, the goals of price stability and maximum employment and financial stability are complementary. So let me finish by noting that in his 2015 presidential address to the American Financial Association, Luigi Zingales posed the question, does finance benefit society? So I think academics, and I would believe most central bankers, would typically say yes to that question. A recent survey indicates that the average American is much less certain. I'm very hopeful that the considerable efforts underway across the globe will change that. I do believe it's our responsibility to ensure that we create and maintain a financial system that the public views as being beneficial and one that truly is. Thank you for your attention. Happy to take questions.
Thanks very much for those very intelligent comments on a complicated issue. Please stay. Just to remind everybody, please limit yourself to one question for Dr. Mester, and please state your name and affiliation at the time you receive the microphone.
Hi, my name is Martin Lubrink from Victoria University in Wellington. One of the elements that you highlighted as being important to contribute to financial stability is a credible resolution system. Would you be willing and able to share your views on how Europe has implemented that, given the perilous state of Italian banks?
So I think there's people in the audience here who probably know a lot more about that, would be able to comment on that. I can tell you about the U.S. system in terms of the Orderly Liquidation Authority. I think that is a good, a worthy approach to take. There's another counter approach that was contemplated, which was a bankruptcy provision. And I also think that has some merit to it as well. I've been pleased with how the Orderly Liquidation Authority has been developed, and I think that although we haven't had to use it yet, thank God, I also think that it's moving in the right direction. So let me leave it at that.
Dr. Mester, Peter Doherty from the UTS Business School. In your discussion of macroprudential tools, I was a little unclear about the tripartite difference you were referring to, where you talked about rules, a systematic approach to policy use, and discretion. I couldn't quite tell the difference between discretion and rules on the one hand and what the systematic approach was in the middle, because your description of a systematic approach sounded to me like a rule. So could you just elaborate on that, please?
Okay, so when you think about monetary policy, there's some argument and there's actually some legislation that would propose that a monetary policy authority would basically just mechanically set policy based on a simple policy rule, perhaps a Taylor rule, augmented Taylor rule. Okay, I don't believe that that's an approach that we want to take to monetary policy because it's too simple an approach and there's a lot of judgment that has to be done. But that's different than saying we should just randomly, people need to know what our objective function is. They have to know what our reaction function is going to be. So they need to understand the goals and they need to understand how you will likely react. Before the financial crisis in the US, I think people had a fairly good understanding of what the Fed's reaction function was. It changed over time. It wasn't always described by a Taylor rule. And if you look at the literature, you'll see that descriptions of how the Fed behaved would be augmented over time as there was changes in economic conditions. But people pretty much understood what our reaction function would be. I think during the financial crisis, we had to take some untraditional actions. And I think since then, it's been less clear in the minds of the public what our reaction function is going to be, justifiably so because of those non-traditional tools. I think we're now working back to being a little more systematic and trying to convey what our reaction function is, but I think it's going to take learning. I think that idea that somehow we need to convey our reaction function should also apply in general to financial stability. In other words, you want people to understand when would you invoke, right, one of these counter-cyclical tools, or when would you see, what are you looking at to identify whether risks are building up? And so conveying sort of what you're looking at, right, what's your main approach to addressing them. My main approach would be to use the tools first and then think about monetary policy later on. I think conveying that kind of information gives the idea of some kind of systematic approach to financial stability. What I think you don't want to have is, 1 month it looks like there's builds up in real estate and you take one action, and then next 3 months it looks like there's some other thing going on in equity markets, and you convey this idea that you really aren't being systematic about how you're looking at it. So telling the authority, telling the public what model they're using, to assess risk, what kinds of things they're looking at. The financial stability reports that are put out here, I think, are very good. I think that's the kind of way of being systematic about it.
Thank you very much for your talk. Really interesting. Would you agree that the massive quantitative easing, credit easing that the Fed did is implicitly an example of monetary policy responding to the risks of financial instability? And then the persistent low interest rate structure that is developed, I think, largely as a result, do you think that is contributing to maintaining financial stability or the reverse?
So there are 3 periods of quantitative easing in the United States, QE1, 2, and 3. QE1 was really I viewed as giving liquidity to markets, right? It was really intended to improve market functioning. So in that sense, you could think of that as being a financial stability issue, right? So it's what central banks should do in the midst of a financial stability. The last 2 programs were viewed as monetary policy tools in the sense that we had already brought down interest rates to 0. And so when you wanted to increase the amount of monetary easing, that was the method that in the U.S. we chose to do it. So I think of those as I think of QE1 as somewhat different from QE2 and 3. So I think of those as really being monetary. We did that to address our monetary policy goals, not because of financial stability concerns. I think the same thing with the 0 and low interest rates that we're at now, right? These were intended, right, as monetary policy, in pursuit of our monetary policy goals of maximum employment and price stability. That it wasn't done because of financial stability. However, because of the impact that we know that low interest rates can have in terms of risk taking, we certainly are cognizant of the fact, and the FOMC has made very clear and explicit statements that we're monitoring those impacts, right? Perhaps unintended impacts, right? If it goes too far on financial stability. But it's good to remind people that part of the impact of monetary policy is through financial markets. So it's going to impact financial markets in any time. And so it's really, is it inciting, reach for yield behavior and other kinds of behavior because we're at zero for as long as we've been. That's kind of different in this environment than we've seen in the past when we do monetary policy. But at this point, I'm certainly watchful of those kinds of instabilities, and that's one of the reasons I've been saying for the U.S. that's one of the risks I see on the opposite side of, you want to keep interest rates, you want monetary policy to be accommodated, but you also have to think about the risks that you may be generating some financial instability down the line, and how do you balance those? I think that's very important for monetary policymakers to consider.
Loretta, thanks very much. Kevin Davis. In your structural resilience measures, you referred to explicitly to the leverage ratio. I don't think you mentioned the risk-weighted ratio. And you also referred earlier to the issues about complexity and granularity of the regulatory measures and the difficulties that creates. So I wonder whether should one interpret that as being concerns about whether Basel have gone too far with complication and risk weights and internal models and so on, and that we need to rely more on other techniques like the stress tests and so on?
So I'm a big fan of the stress tests. I think that they've actually proven to be quite useful as an augment. I mean, you need to have capital levels at a high enough level, because I think those tools that work across the cycle are very important. I think of the stress test in the same way, right? We can model sort of what stresses we think that we want the banking industry to be cognizant of, and then see whether they have enough capital level to handle that. I think you need a complement. You need risk-weighted. I'm a fan of risk-weighted capital requirements. I didn't mean to imply I wasn't, right? But I like the leverage ratio. I think those are sort of two parts that I think together work well. I am very concerned sometimes when things get overly complex, because I think sometimes we become so. It's so complex that it's very difficult, perhaps, to discern when there are, gaming going around to sort of avoid some of those things. And I do think it's worthwhile thinking about, do we want to think about that explicitly? Have we become so, complex that we've kind of made it harder to monitor rather than easier? But I didn't mean to imply that I'm not in favor of risk-based capital standards. I think they're very important. It's just how much risk and how far do we want to go. And I think there are actually people working on those in the academia about sort of that trade-off, which I think that's a really interesting line of research. It has very practical implications for policymakers and regulators.
Thorsten Beck, thank you for the very interesting talk, and you very eloquently pointed to this trade-off in terms of how much finance, the risk-return trade-off. And I wonder, isn't it not just about how much finance, but also what type of finance in terms of risk return? There's talk about mortgage lending versus more enterprise lending, lending business versus non-lending business, or private sector versus government lending, for example, in the case of the Eurozone. To which extent is this important for the debate, and to which extent should policymakers or regulatory authorities like you intervene? Or to which extent is this more the role of politicians, like in the case of the Volcker rule, for example, to kind of determine what type of finance would be optimal in terms of risk-return trade-off?
So that's a really deep question there, and many, many aspects of it. So firstly, one of the reasons I think it's important that we have these sort of resiliency standards is we kind of want the market to allocate credit, right? First best, that would be what we'd want. But we have to make sure that, right, the regulations are sort of supportive of that, right? So, my view would be like if we can set the financial stability, capital requirements, stress tests, all those resiliency tools that work through the cycle at the right levels, right? Then we let the market allocate credit across sectors. I think that's the way you have a vibrant economy, right? So, I'm a firm believer that finance can be a very beneficial thing to the economy, and that we shouldn't just think of all finance as bad, even though the thing I mentioned at the end, the survey suggests Americans are skeptical of that now after having lived through the crisis, and perhaps rightly so, given what happened. But the real question is, where do you set that? So, I'm a firm believer in letting the market allocate the credit and then setting the resiliency standards. Who sets the resiliency standards? You're right. In some sense, that's a political issue, and countries have to decide, where that should be. And different countries have different governance structures about that. In terms of, we in the U.S., we have independence in terms of setting monetary policy, but independence with accountability in that Janet Yellen, the chair, goes up and testifies. There's a monetary policy report. There's a lot of information given to Congress so that they can evaluate how well the policy is going. I would think the same thing could be true on financial stability policy. And certainly Governor Cirillo, who has been the point person at the Federal Reserve Board, right, goes and testifies about financial stability issues, as well as the other regulators in the U.S. So again, who sets the standard? I think it's going to be, has to be, even if it's officially by, a central bank or other regulator, it's going to have to be, right, endorsed by the political system. So you're exactly right. I think that in terms of when to intervene, that's a separate question, right? That's a question where if you've identified building financial instability in a particular sector, for example, housing, or in excessive leverage lending, then that's a question for the policymakers then to say, okay, should they intervene and what action should they take? And that's where I think being systematic about what are the things you're looking at, are you systematically identifying risk, is going to be very important.
Oh, hello, my name's Keith Woodward, just from the uni here. And my question is just about the financial crisis, which was originally called the housing crisis. And it was, you said that the macroprudential measures were, you listed many of them, but in Australia that seems to mean loan to valuation ratios. And you said that you don't think that's something that you'd look at in the US because you don't know much about it. But in Australia and New Zealand, with falling interest rates and house prices that are sky high, that's seen as, well, some people think it's the only measure to keep a lid on house prices. What are some other ways that you think countries like Australia and New Zealand with falling interest rates could keep a lid on house prices without using loan to valuation ratios?
Well, again, I think you have the same situation that we would have in the sense that you want to make sure that the financial system, so the banking system, which is more concentrated here and more dominant here as a way of giving finance, that has to be sound so that it can accept a shock, right? So again, it's the resiliency of the financial system over all stages of the business cycle is the first line of defense. And then the question is, if you see building, if you see a housing market build up in terms of where you think that there's some significant risk, there would be steps to take. In Australia, perhaps that would be a tool that would be, one of the first tools. Perhaps you would be more amenable to using interest rate policy than I would be in the U.S. The U.S., we just have never really put on that kind of restriction in terms of, except overall, sort of getting a loan, you need to have so much money down or else you need insurance. But as policymakers, I don't think we know enough to be able to calibrate that very well, to understand the impact it would have in our economy, perhaps because it's more complex. But I just don't feel that we've ever had experience with that I would want that to be the first thing we would use. So in my view, it would be much better if we focus on trying to make sure that the system overall is resilient through all sorts of different kinds of situations, right? And then, right, thinking about the buffers for the large banks, and then and only then, moving to other tools, and perhaps in the U.S. it would then be thinking about monetary policy. But again, when we get to the point where risks are that high, there's I think that there's a blurring really between monetary policy risk and financial stability risk because we need a sound financial system to actually have a sound economy.
One last question.
Dr. Mester, welcome to Sydney. David Rogers from The Australian. Just wondering, with the strong bounce in payrolls last month, what's your view of the US jobs market? In light of that, are you comfortable with market expectations that US interest rates will remain on hold for the rest of the year?
So I'm positive about the US labor market. You're exactly right. We had a very weak May report, and then we saw a stronger report in June, and I think if you just look over the time, since the recovery and the expansion, the U.S. labor market is really strengthened over that time. So I think the labor market is doing quite well. In terms of where market expectations are, I mean, when I think about policy, I think, and the outlook, right? I'm always looking at the median run outlook. So what's the outlook for the U.S. economy over the median run? And that's how I think about monetary policy. And when I look at our monetary policy goals, I think we've made, we're basically at full employment from the point of view of what monetary policy can do. And I think that we're making progress on the inflation goal. So I'm comfortable that we're not behind the curve. But I do think that, a gradual upward tilt to interest rates is appropriate for the U.S. economy. The timing, of course, of when the next step would be or the actual slope of that path is going to depend on how the economy evolves.
Thank you very much.
Thank you. Thank you all for being here, and I'm looking forward to talking to more of you during the breaks.